This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Speakers, publishers, consultants, coaches, and info marketers unite. The Speaking of Wealth Show is your roadmap to success and significance. Learn the latest tools, technologies, and tactics to get more bookings, sell more products, and attract more clients. If you're looking to increase your direct response sales, create a big-time personal brand, and become the go-to guru, the Speaking of Wealth Show is for you. Here's your host, Jason Hartman.
It is my pleasure to welcome Keith Butcher. He is the founder of Butcher Joseph. And why are we having him on the show? Well, this year is the biggest year in the history of the world for one particular thing. And that is the number of people turning 65 years old. And what does that mean? That means a lot of people will be retiring and businesses will be changing hands. A lot of business owners are thinking, what is my exit plan? How do I sell my company? Do I leave it to my kids? What do I do? Do I leave it to my employees? And that's what we're going to talk about today. Keith, welcome. How are you?
I'm good. Great. Thanks, Jason. Thanks for having me on.
And you're coming to us from right nearby in Miami, Florida, right?
Sunny Miami, staring at the blue ocean right now.
Excellent. Excellent. Well, talk to us a little bit about what it is you do and why it's important.
So what we do is we help founders and family-owned businesses figure out what to do for the next round of ownership of these companies. As you just stated, the silver tsunami, as everybody calls it, is a real thing. There's going to be an unprecedented number of businesses changing hands. And the reality is, and I've been doing this 20 plus years, not to age myself, there is not nearly as much family succession going on anymore, and actually like a fraction of it. And so the reality is they're all trying to find another alternative. And so what we do for companies is we help them figure out what is the best next stage of legacy for that business. Might be selling the business, but it also might be figuring out a way to do an employee ownership buyout. And we've spent the last 20 years specializing in that.
You know, it's interesting. Everybody is familiar with a very popular show called Succession, right? I'm sure you know about that show and those kids that are just waiting for dad to die so they can take over. Why isn't there that much family succession? What's your take on that? Is it that the kids just aren't interested in the parents' business, or that the baby boomers just didn't have enough kids? We talk about that a lot. What's the reason for the lack of family succession?
You know, and I'm not an expert in the sort of demographic shifts, but I would say just from our shared experience, it's a lot of it is just that it's boring. Like running a business is boring. And running these companies and a lot of these kids in this, they've grown up, a lot of them with some wealth now, because a lot of these are sort of second generation, and they have more options available to them. We have many founder owners who selling fabulous businesses with a less than high school education, but the next generation, their aperture is widened. They have much better education. They have all the opportunities in the world. And just their options are greater than what might have happened in the past. Yeah. And so they go and be tech people or doctors or lawyers or whatever else they're going to be. And they don't want to go run the HVAC service business that makes a lot of money. Right.
Yeah. They want to be digital nomads, I think, and travel the world. True. And have internet businesses and stuff like that. So that makes a lot of sense. Okay, good. Well, we've got some visuals that you have supplied for us. Of course, how did you get into this, and why did you found the company?
So I got into it I started working in employee ownership back in 1998. And the reason for that is I was just coming out of law school, and Congress passed a new law to allow ESOPs, or employee trusts, to be shareholders of S corporations. And feels like a simple thing to say, but it was really profound, because it changed the tax benefit landscape for those businesses just profoundly, made them non-taxpayers. And so I was at the time working for Coopers and Lybrand before they all merged. And we started thinking internally in the tax group about, well, how is this going to change? And that's where I really got embedded in it. Then I went to work for Morgan Stanley's investment bank and grew up a business around this within the bank. And then we ultimately, my business partner and I were both at Morgan Stanley. We decided to put our shingle out in 2011. And we've been, really fortunate to build a really nice business and have a bunch of super bright people and do a bunch of transactions for wonderful families.
Keith, give us the compared to what, though. You said in 1998, I believe, Congress changed the law allowing S corps to hold ESOP, or am I saying that right?
Other way around.
Yeah.
Other way around. So to be an S corporation shareholder in the U.S., you have to be a certain category. You have to be a human being. You have to be a certain kind of trust. You can't be another company or another corporation, and very few like trusts qualify. And so for that, only a C Corp could have a shareholder that was an employee trust. And they figured out, well, most of the businesses out there are S Corps that are small businesses.
Right.
And so we're missing this entire segment. And so Congress came in and they modified the law and added that. And so now an ESOP is also a qualified shareholder of a S Corp.
Okay. So in other words, before, the employee stock ownership plan could only be involved with a C Corp, which is
Correct.
Usually a much larger corporation where they have retained earnings and they have double taxation, whereas the smaller businesses want to be S Corps because it's a pass-through entity. Got it. Okay, good. What is this slide telling us?
This slide's telling us two things. One, it's telling us that for business owners, for the last 3 or 4 or 5 years, we've had a red hot sell side market. Those sellers had all the power and the leverage in the marketplace. And so they were getting very attractive valuations. A lot of it was being driven by interest rates. And so in that circumstance, other succession options weren't quite as attractive. And so you might have looked at an employee buyout and said, geez, there's a strategic buyer that might pay me 20% more. Or there's a private equity fund that can get a bunch of leverage and might pay me 20% more. And so as a result, not that it wasn't a popular transaction, it just isn't as popular in that interest rate environment and with those valuations. And what's happened is we've reverted to the mean with interest rates going up, valuations have come back for privately held companies. And now this particular structure is very, very popular again, and popular in the sense that the ESOP buyout can offer the same valuation that the traditional market would provide. That's the one takeaway from this slide. The other takeaway is what we talked about at the start, which is like the percentage of sort of age 55 and up human beings that own these businesses, these private business assets. And it's just an unbelievable number. It's like 70% or something.
Yeah.
Or 63.
So when it comes to businesses then, and the market for business buyers and sellers, are we moving into more of a buyer's market because supply will exceed demand? Or I talk about this in the real estate market every day, as you know, but how does it look in the business market?
Where we live, which is what I would call sort of the small, medium, lower middle market kind of businesses, it definitely shifted about a year ago, maybe a year and a half ago into it kind of got to equality between the sellers and buyers. And then about first quarter of last year, it really shifted to the buy side, and buyers had a lot of it. And what happened was sellers just came away from the market because they had to absorb this new normal. And so if you were going in and you were like, geez, I'm going to get this great valuation, I'm going to control the process, and then you found out the market didn't like you anymore as much. Mm-hmm. Instead of transacting, the market just came to a halt for about 2-3 quarters, literally. Like you can see unprecedented reduction in transactions happening. Now it kind of came back alive in a big way in like November, December. And now it's rolling again. And just from experience and go through cycles, to me, is just the absorption of the seller understanding this is the new market. And if I want to do something, I got to understand the realities of this new market. and I'm just going to have to transact.
Based on the timing you just shared, though, it sounds a lot like the impact of interest rates. Am I wrong?
Well, for sure. The interest rates, I mean, a lot of DCF models out there, right, for valuation. And discounted cash flow is driven by a discount rate, and that discount rate is driven by interest rates inherently. And so as those went up, valuations came back. Also, a lot of it's driven by the amount of leverage that the folks can get out there. We're not active in the real estate market, and I don't know, and I suspect that leverage has come down there also. But in the private business market, the amount of leverage you can get on a company contracted dramatically at the end of 22, really. And so you had two effects. One is it costs more, right, to borrow part of your purchase proceeds or part of the proceeds that you're trying to buy a company with. And second, you're being offered less, so you have to put more equity in.
Yeah. Yeah. And so this is the same thing that I've been describing in the real estate market. At some point, parties will each capitulate on each side and they'll start to come to a meeting of the minds. But it takes a while for human psychology to adjust to the market. In the residential real estate market, it's been buyers accepting the new normal, which is, look, you're just going to get less house than you did before. The prices have gone up. The rates have gone up. It's just not the same world. And for a while, they just reject and say, no, I'm not going to do anything. It's ridiculous. It's unaffordable. And then eventually they just decide, well, look, if we're ever going to do anything, we might as well do it. And that's exactly what happens. And in any market, in any asset class, that's what always happens.
And for a short period of time, they blame us, right? For some reason, we're not beating the market.
Yeah, right, exactly. Okay, good. Well, this demographic issue of all of these businesses coming up for sale is really quite interesting. It'll create problems and opportunities as it unfolds. And it's going to take a long time to unfold. But this year is that sort of peak year of 65, which is really quite interesting. What does this chart tell us?
Well, this chart is telling, so we do traditional sell side transactions to strategics and private equity funds and whatnot. But the special sauce is really this employee buyout using an ESOP trust, which has been around for a long time. We didn't create it. We've just figured out how to utilize it in a really effective manner. And what this slide is showing is sort of the value to this employee base. So we have two stakeholders that we're primarily concerned with. Our first stakeholders are as our founder, our owner, that we're serving as an advisor. And we want to deliver a great valuation for them. We want to deliver a tax-effective transaction, which the ESOP provides us a benefit there. And on the other side, with the ESOP buyouts, we have the other stakeholder is the management group, key employees, and the general employees. And how are they going to participate in it? And what we try to illustrate is this is like this no money down opportunity for employees. If an owner wants to do a transaction like this and does it, then the employees, basically, we sort of fully lever the business. And as it pays off over time, the employees are ultimately the owner of the business. And so if you look at a company that's been in the ESOP structure for 10 years, there's lots of them, thousands of them. They tend to have no leverage. They have no debt left. And the employees own 100% of the equity. And it's fully delevered, and it's created tremendous retirement value for everybody in the company. And that's sort of the illustration is this. It's not a get rich quick. It's over time. The employees pay down the debt that was brought in over time, or that was brought in at the start to purchase it, and they build their equity value. Coincidentally enough, when we are talking to employee bases and we're rolling this out, our example is buying a home, because it's something that they can sort of associate with that is common knowledge. We say, listen, if you're going to buy a house, you're going to put 20% down, and then you're going to pay that house off over time, and you're going to grow equity value in it. Well, this is the exact same thing. It's just instead of you having to put the 20% down, the seller is going to lend you that money and going to lend it to the company. You don't have to pay anything out of pocket, and the company's going to pay that off like an income-producing property would.
Mm-hmm. Yeah. So what's interesting about this is it's going to give, and it has been giving, it's not a new thing. And this is, by the way, everybody's familiar with 1031 tax deferred exchanges. This is IRS section 1042, right? So similar to the 1031, you're using 1042 for the business deal, but it's going to give a lot more people access to business ownership. And that's a really interesting benefit where people can, get into the investor class rather than being just in the employee class. So that's great. I'm curious, are these deals on the employee side of it, when they purchase, are they ever tied to vesting arrangements and non-compete agreements and things like that?
The ESOP trust itself that owns the stock is a retirement plan under ERISA. So it's like a 401k plan or something, and subject to the same rules. So typically the vesting is really just time vesting. And so it basically vests 20% a year over a 5-year period. Mm-hmm. And so from the day you join the company or the day of the start of the plan. So if you, and rarely ever do you give any prior credit. So somebody could have been with the company for 30 years. The owner decides to do this transaction. They start day one with everybody else because it's a new benefit, and they have to stay the next 5 years to own their account, so to speak, from a time benefit. And if you leave, you surrender the equity that you had in your account, whatever percentage you had invested in.
But if they leave after 2 years, they'll have 40% of their vesting, right?
That's right. That's the simple math.
And to get the whole thing, they got to stay 5 years. Got it. Okay.
Yep.
All right, good. What else do you want people to know? Any more of the visuals here you want to discuss? Or
I would say the powerful piece is really and really underappreciated is this tax deferral for the owners, because at the core of it, we do these illustrations in the bottom left here. We're doing sort of a parody of here's what it would be. Here's how much value you would have to sell this same business for and get the same after tax result, which seems like simple math, but people don't pay attention to it. In the ESOP style transaction, you can structure it just like a real estate transaction where you can defer the capital gain into basically you take your proceeds and go reinvest it in another asset, which is stocks and bonds of U.S. companies. And by doing that, you've deferred that tax. You're sort of using that money multiplier into that. And so for us, we try to take owners through that and say, listen, yeah, there are positives and negatives to every type of transaction, but this one is very pure. If you sell a business for 10, or if you have a $10 million EBITDA business and you sell it and you pay 25% more of tax on it through long-term capital gain, federal and sort of average state, then in order for me to get you the same result, I got to sell that same business for 2.7 times more multiple on your earnings. Wow. And so if I sold it, I sold it for 8, I got to sell that same business for 10.7 times to get you the same result, which usually is impossible is the answer.
Yeah. Yeah, that's amazing. And folks, it goes to show you how important learning the tax code is and how important it is to manage taxation, because that's just, it's like a life or death, make or break thing in that example. It's a perfect example. Yeah. Okay. What else?
Yeah, I think on this page, what we're talking about is just that at the end of the day, there aren't a lot of losers in this style of transaction. You've got families and founders who get to sell their business in a way that preserves legacy and has a lot of soft benefits that aren't just economic, right? And I believe after doing this 20 years that's never been more relevant than it is today. I mean, business owners genuinely care about this. I don't know 15, 20 years ago if it was as prevalent, but today we've gone through a pandemic, we've gone through all this stuff. I just feel like there's a humanization of these family businesses now. And so that's the first piece. And then the beneficiaries of it ultimately are the employees in the management group, and their ability to stay as a standalone company and build for themselves and get a version of the same opportunity that family had that was building it up over time.
Yeah, it's really some good, amazing benefits.
Yeah, the only other point I was going to make, Jason, is if you think about it, since the pandemic, what is on the top 1, 2, 3, if not the number one issue for every company is employee recruitment and retention. And there is no doubt statistically, and they've been tracking employee-owned companies for years and years and years, there's no doubt the recruiting and retention in these companies is far superior to their peers. Yeah. And which is, spotlight on that today.
And that means that the new employees that are hired after the deal can participate in the ownership, right?
Absolutely.
Yeah. Okay. And like indefinitely? I mean, there's only so much ownership to go around. What happens? Do you dilute the current owners, or what happens?
Well, it's kind of a cycle thing because you also have folks that are going to retire, and the company makes a market for them and brings the stock back in and recirculates it. And so there's sort of this careful management of the allocation of stock that you do internally. Well-run employee-owned companies pay very close attention to that sort of cycle so that they're constantly creating new opportunity for employees that are coming in new, but also respecting the folks that have been there a long time and actually creating liquidity for them because they're getting older in age and they're getting to a point where maybe they shouldn't have such a concentrated interest in one asset and they're 59 or 63 years old or something, and they create some liquidity. So they manage that very carefully to make sure there's a flow of equity between those different maturities of employees.
And there's not much awareness for this structure, is there?
It's the greatest question mark in the world. We take folks who have been, I've been doing this a long time, many companies, every size, every industry you can imagine. And the one question I consistently get is I take them through it and they go, God, it sounds too good to be true. Why isn't everybody doing this? And the simple answer is because two things. One is because in the past, there hasn't been as much capital as there is today available to it. And so over time, capital markets have been created. What I mean by that is if you go to Bank of America, they have an ESOP lending group that specializes in this. PNC, JP Morgan, every major regional bank has a lending group that specializes in this. So now capital is unleashed. And the second piece is the sales force out there that is educating business owners is really all the investment bankers like me and a tiny, tiny percentage. Like we're illustrating here, we think like 1% of them have any familiarity with this structure. And so what do is they avoid it because it's not something they're an expert in. Then they just go, let's sell your business to X. I don't want to go through this process. And I think you've had exit planners on your show in the past. And that's a more fulsome process. Like an exit planner goes in, they say, what is the best thing to do? Well, and not to be skeptical, but a lot of bankers just want to sell an asset and make a fee.
Right.
And the easiest way to do that is to package it up and sell it to a private equity group or sell it to a strategic buyer and not go through all this brain damage. Yeah. And there are so many. We actually have our own private equity group. We have 16 companies, and we do this transaction in our private equity fund where we're capitalizing the employee buyout. And the interesting part is if you talk to any of the CEOs of the companies that we've invested in, they would all say, my investment banker never even mentioned the structure. Mm-hmm. And I said, exactly why there isn't 50,000 companies in this structure. There's only 10.
Yeah, right. That's just not in their interest to mention it or bring it up. Okay, give us some key takeaways and let's wrap it up.
Yeah, I think first is, if you're a business owner and you're thinking about succession, I think the reality is, as you described, is you have to get honest with yourself and intellectually honest about the market we're in and the market it isn't anymore. And I think once you get there, then, I think there's a real opportunity for families and founders to look at it and say, let's do a fulsome approach of what is the best transaction on an effective basis, which so few of these folks spend time on. On a tax-effective basis, what is the best transaction for this business that's going to take care of what is probably our largest asset of our family? Like if you look at most of these family business owners, this is their single largest asset they own. And that's really it at the end of the day.
Yeah, good stuff. Keith, where can people find you? Give out your website.
ButcherJoseph.com.
Excellent. Keith Butcher, thanks for joining us.
Thanks, Jason.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.